Hello, everyone. Thanks for tuning in. This is Josh Wren. I'm the CEO and founder of Insellerate. Thanks to the CMBA for letting us take over the Connect podcast today. Really excited today to have Rob Crispin as a guest speaker. Rob's very well known in the industry. Doesn't need a whole lot of introduction, but before we get to Rob, thanks Rob for coming on. A little pitch about Insellerate. First, Insellerate, we're really in the business of helping lenders close more loans. We do that through better borrower engagement, helping you build customers for life. Last week, we launched our new Customer for Life product that really helps lenders engage with the customers and stuff more than just email marketing. We're providing valuable data, things like values of the home, neighborhood statistics, and that's all built into the email marketing platform, and also does social media, direct mail, text messages, phone calls, ringless voicemail, really helping you engage your borrowers and build customers for life.
Hi, this is Susan with the California MBA, and we just finished our Mortgage Innovators Conference last week, and now we are launched our mortgageinnovators.com website. And this is going to be a site for anyone in the real estate finance industry that is looking to review what technology solutions are out there. We've got categories like acquisition, origination, processing, closing, post-closing, and capital markets. So this is designed to be one-stop shopping for the mortgage industry for new tech needs and anything that you want in the tech space. So visit mortgageinnovators.com and look forward to driving efficiency and progress in the years to come.
So without further ado, Rob, thanks for joining us.
You bet.
I think for those of you who haven't read the Rob Crispin blog, it's been around for how many years now?
A couple months. Been around. It's been around several years. Put it that way.
Yeah, is it a decade now? Going on a decade?
Usually a decade. It actually started before that, but very informally back, early 2000s. And then in 2008, that's when it started to pick up a little bit of steam.
Yeah, no, definitely. It's that's what people go to the industry right now. They get industry news, what's going on. So really treat to have you here to be able to give us some updates. So since you're here, the biggest question that most people have that, I think that you get a lot of is, what do the rates look like? What's the secondary market look like? What's going on with the CFPB? So I think we can maybe start with rates. Luckily for us in the industry, we've gained a couple hundred basis points of pricing back over the last, 30 days. We're still down 250, 300 basis points from where we were when the market had really, bottomed out. So what do you see with rates? And also I asked a question about inflation. Like, where do you see that affecting us with rates?
Gee, direction of rates. If I'd known you were going to ask me that, Josh, I would have brought a coin to flip. A couple months ago, given the election and so forth, and the Democratic swing in politics, a lot of people were saying rates are going to go up throughout 2021, and here we are in early mid-May, and they did go up a little bit, as you mentioned, a month or two ago, but they've come back down. And I think it's important for people to think about why rates are moving at all. We have the stimulus to pay for, and the stimulus packages and aid packages have caused a fear of inflation. So there's some thinking that things are going to be, or I should say, prices are going to be inflated going forward. Now, we haven't quite seen that as much as some people thought. There is inflation in some areas of the economy, but the feeling is that when the pandemic winds down, and I guess about a third or 30 or 40% of the U.S. population has been vaccinated at this point, people are going to want to spend, and they're going to want to stay. In the Marriotts, they're going to want to eat at the local restaurants. They're going to want to go to Disneyland, which opened a week or two ago. And so there's this pent-up demand for goods and services. I don't know the last time. It's probably been well over a year since I bought a new pair of socks or a necktie or a dress shirt. So there's pent-up demand out there, and that is thought to cause inflation at some point. But it's not quite there yet. And so I think the market got a little bit ahead of itself a month or two ago when rates moved higher. But regardless of the administration administration, really, we know at some point we're going to have to pay for the stimulus that is out there, and through revenue, which mainly comes from taxes. So there's, the feeling that taxes are going to go up and so forth and so on. But in general, I would say there's more pressure on rates to move higher through the year, but not dramatically so. And in fact, my daughter recently bought a house, and she got a 2 3/4 30-year fixed rate loan. And so 2 3/4, if rates are really 3% or lower, there's not a lot to complain about. And so rates may tend to go higher. That's where people are putting their money on higher rates throughout the year, but they're still doing their job and helping borrowers and so forth. But yeah, we could expect to see a little bit higher rates as the year goes forward.
That makes sense. I think from the borrower perspective, it's the rates, like you said, 2.75%. It may not be 2 1/4, but it's below 3%. That's an unbelievably low interest rate, right? There's just, it's hard to argue against that. That's a low interest rate, right?
No, and people, I think loan officers who realize that will be better off in the long run. Frankly, when you talk to a loan officer who's been in the business for many, many years, and they'll tell some story about rates being 10, 15, 20% when they got started and so forth. But it seems like regardless of interest rate environment, keeping a focus on the customer and retaining customers regardless of interest rate environment is what tends to help successful lenders and successful loan officers. So it's nice to talk about rates, where rates going to go. It's kind of like talking about the weather. If it's going to rain or not. You can't really do much about it, but you can kind of prepare. You can just go about your life regardless of the weather or regardless of where interest rates are.
No, I think that's right. I think what you said about the loan office, as you know, I've been in the industry for 22 years. I was a loan officer for almost 4 years, and then I started my first mortgage company and trained loan officers. You're right. The ones that really understand where rates, what's successful. I remember selling 7.5% with 3 points on an FHA purchase. That was what people were, hey, you want the 7.5% interest rate? That's 3 points. It's a purchase. And that was, people were happy. Then I remember people were refinancing to take cash out when FHA had 95% cash out, and they were taking 7.5% interest rates at 3 points to take cash out. So there's always a market there. But I think what you said is important. Having those customers and keeping those customers, maintaining those customers is really important, right? I think our worst year during the crash of the market, the market crash, 10 plus years ago, I think it was like 1.2 trillion in originations. Still a lot of business, right? Right now we're looking at 3 to 4 trillion. So maybe a down year is going to be 2.5 trillion. It's still a ton amount of business. So having those customers, making them happy, keeping them happy, is really important. It's actually important for more than one reason, right? One is keep your customers happy. They're going to close more with you. They're going to refer you business. They're going to be repeat customers, but they're also going to do something else. They're going to complain less. That's and so that's the next question we're going to talk about a little bit is like the CFPB and regulation. Rob and I are both involved with People's Bank, so I know Rob knows this from a level of when you get complaints, when customers are happy, the regulators seem to they're happier because if you're making people happy, then you're not doing something wrong. They're happier. But when they start getting lots of complaints, then they want to start looking under the hood. Why are people complaining? That's only so there's so much value in keeping customers happy. So with that, last 4 years, we saw the CFPB play a smaller role, not have as much power, not be as funded or authorized or backed by administration to do what they were originally built to do under the Obama administration. Now, obviously, the new administration, I think there's going to be a recharge in this CFPB and some of this regulation. What do you see there? Do you see that taken up? Do you see more fines happening? How do you see the market reacting to that?
Well, we knew that was going to happen with the new administration as well. The Consumer Finance Protection Bureau has certainly gone through kind of a roller coaster in its history, it started off, with fangs bared and all kinds of enforcement actions under Richard Cordray, and he was out to make a name for himself, make a name for the Bureau with a capital B. And so the market was definitely, I should say, lenders and servicers were running scared. And one of the issues back then was that we really didn't know what to expect. And we really, they could come after an institution arguably even when that institution wasn't quite sure of the rules. And I started to hear a lot of CEOs and owners say, just tell us the rules. We'll play by them, but tell us what the rules are. Last 4 years, you're right, have been a change, a welcome change to lenders and servicers because the CFPB became more of an educational tool that took in input from the industry. The CFPB, I don't know if they were exactly kinder and gentler, but there were fewer enforcement actions, and that's probably because of a combination of they were trying to educate the industry, but also so many lenders and servicers cleaned up their act, and so there really wasn't hardcore issues going on, at least that I could see or hear about. So now we have a new administration, and the Biden administration has made it very clear that it's pro borrower, pro consumer, pro the little guy, little gal, the little person. And the appointee or the nominee has echoed that in terms of being kind of more in the Bernie Sanders, Elizabeth Warren camp, in terms of big financial institutions aren't necessarily good, and the little guy, little gal is always going to prevail. And I think we're starting to see that to some extent. Foreclosures, gee, let's not have any foreclosures until 2022. Well, how does that impact lenders? How does that impact the servicing portfolios that are out there? So, excuse me. So the feeling is that the CFPB has swung back more toward where it was in the initial years of its creation, but I don't think it'll go quite back that far. I don't think Richard Cordray, like I said, set out to make a name for himself and collected a lot of revenue through enforcement actions and fines and so forth. And really, if the CFPB was holding for you on line 2, you didn't want to pick up that call. Now I don't think it's quite that bad. Now I think there's probably a little bit more of a hybrid because, as I said earlier, so many lenders and so many servicers have cleaned up their act. They are doing things in a compliant manner. They are, to your point earlier, they are paying attention to the consumer, because a lack of complaints generally is a good thing. And when they start to hear complaints about a particular servicing institution or lender, that's when maybe they start to take notice. So with the industry having changed significantly from where it was 10 or 12 years ago to where it is now, I think maybe there are other financial services that the CFPB can focus on rather than residential lending. But because of the pandemic, we'll see, they'll be involved, but probably not to as great a degree as they were before. Are you hearing that from your clients, that there's a definite fear out there or a sense that things have changed?
Yeah, I'm hearing from some of the clients that they're concerned with, and they're asking, hey, we really want to make sure double check our marketing's compliant, everything's right like it should be, everything's being disclosed correctly, because we're afraid that the CFPB may pick up some enforcement actions. And I think it's interesting what you said. They're trying to protect the little people. And what happens though, and I just saw this for after the CFPB first did what they did, it costed it costs everyone actually money. It actually costs the little people. When they do too much of this, it doesn't help the little people. It actually winds up hurting the little people because it makes the cost so much greater for everyone to do these transactions. And people don't understand, when you don't let someone foreclose on loans, then what's the service and value of a portfolio, and what's the security risk of owning, a portfolio of loans if all of a sudden you can't foreclose on them? Those things make drastic impact, but then makes rates more expensive, but and guidelines tougher. Then it makes less people be able to afford homes. So it's not always, too much action is too much. So I hope you're right about the education, because that was definitely what we saw at the CFPB when it first started. They didn't say, hey, here's what you need to be doing. They just said, you know what? We don't know what you need to be doing. We're not sure what you're doing wrong, but we're going to look at enough information. We're going to find something we don't like. And if it's a law or not a law, we're going to fine you and then make it a law. And that was kind of that was the action. And, that was obviously, it's not helpful. So I'm glad to hear that it's becoming more, or at least it has more education. Because by and large, lenders want to do the right thing. People want to do the right thing. Tell them what the right thing is. And, most people don't want to. Bad actors are always bad actors, no matter what. No matter who you have enforcing, they're always bad actors. So tell people what they need to do, and go after the bad actors. I think that's best for the market.
So I have a question, and I'm not here to plug Insellerate necessarily, but does the use have you heard that the use of Insellerate and the focus on the consumer actually, has the CFPB ever examined a company that has used Insellerate or come across Insellerate, or what has been your exposure to the Consumer Finance Protection Bureau?
That's a really good question. I would have to look back what our customers have potentially been used. I do know this, whether it's a CFPB or it's regulators. I know at People's Bank, when they use Insellerate, we gave access to all the phone call recordings and customer logs basically through Insellerate. So there's definitely a pickup. And I think that's something that, just from a standpoint of customer service, one of the things that I read over and over again, if you read a complaint, and every complaint I ever got, and complaints, they complain to the company, then they want to complain to the regulators. They always say something about the problem, but really what is in that first paragraph is, I called so-and-so and they never called me back, right? I didn't have any contact. And that becomes one of the biggest chief complaints, because now it's like, hey, you're not making me happy. You're not even responding to me anymore. This loan officer's not talking. I'm going to go ahead and make a complaint to the regulators because I have no one else to talk to, right? So first, what we found was, by using contact management strategies where you ensured people get called and that was logged and maintained, that helped loan officers and customers, stay informed with one another. So those complaints became less. And then going back through and being able to have a system to go, I'm going to go ahead and look at every communication that you've had, every email, text, and phone call, and listen to the phone calls, read the text messages, look at the emails that you sent to and from this customer to see if you're doing your job correctly, right? So there was this whole coaching opportunity where, people started coaching. And then ultimately, when the regulators say, I want to see all these calls, I want to have access to these to be, they need to be monitored and we need to look through them, they had access to the calls as well. So definitely compliance has been something that our platform has helped lenders with. And it gives them the ability to now know all the communication, marketing, everything that's gone to a consumer all in one spot, which is actually, that's a requirement. If you market to someone, you get a loan from a customer, the CFPB can come and ask you basically, how did you get a hold of this person, right? How they talk to you? Oh, they went online. What web page did they go to? What did it look like, right? Oh, you emailed them. What did you email them? When you called them, what did you say? That can be as far as a requirement the CFPB actually can request from a lender, and not just the CFPB, state regulators, right? The all the state licensing boards can do the same thing. So it's definitely important for lenders to have a system to manage that, because complaints are, that's expensive, and it's not just trying to avoid the fine. It's really trying to do a good job for customers, so you make them happy, you convert more customers, you get referral business, right? So it's a win-win, at the end of the day, by making people complain less and giving them better service.
Yeah, I would agree. It's the companies that or individuals who ignore a complaint that run a higher risk than those that don't. It's just like in life, gee, I heard a funny noise in my engine. Well, what'd you do about it? Well, I figured it would go away. as opposed to taking into the shop and having them,
Fixed itself.
hear funny noise, it leads to problems down the road that you didn't foresee. It's better just to take care of these things. So,
that's right. No,
good
that's
point,
good.
Josh.
That's a good. Yeah, that's a good analogy. You're right. Yeah, it helps lenders in the current and in the future environment. Taking care of these things, and then really, I think the bigger picture is if you're a lender, you have to understand that you're in the service industry, right? So and it's financial services, but it's the service industry. So that means we make money based off the service we give to people, because we're all selling a commodity right now. I mean, unless you have a non-QM loan that's only your loan, or a jumbo program that's only your jumbo program, by and large, the transactions are Fannie, Freddie, FHA, VA, right? That's where those transactions are, and we're all selling a commodity. So the service is really a differentiator for moving forward in the market and kind of growing market share. With that market share kind of growth trends, what do I see something really fascinating about like the housing market. Is the values, are they going to go up or are they going to go down? There's so many different variables with, home prices. One is if rates rise, home prices should come down a little bit because, affordability goes down. Inflation, well, maybe we do have some inflation in the market and we're seeing it in home values, but then again, is it inflated or do we have a housing shortage? We have a massive housing shortage. So if all these like contrary things that, would affect home prices, and like you said, flipping a coin, you might need a three-sided coin to figure out how it happens. But do you see, let's just ask this, do you see the hyper growth in home prices over the next year or two like they have been over the last 12, 24 months, or do you see that slowing down?
I've been bullish on housing for a while. I think the affordability, rates are still low. The work from home environment has added to that. But even if rates were higher, and even if people weren't working from home, you still have, I think this year I read where nearly 5 million millennials are turning 30.
Wow.
Okay. Granted, some of them already own homes, but builders right now, when you look at single family starts and existing home sales, et cetera, they're building about 1.5 million to 2 million houses a year. All right. You've got, depending on what age range you look at, 70 to 80 million millennials out there. And as I said, about 4 million are turning 30 this year alone. The supply of new houses coming onto the market just can't keep pace. And so you're running up against issues with labor, land, lumber,
yeah.
The price of a permit, and so forth. And a lot of areas are saying, hey, not in my backyard. I don't want 50 units of affordable housing in the lot next door to me. So you have a lot of issues out there that I think will lead to continued housing appreciation, price appreciation. I just don't see a reason why it would go down. I'm not going to generalize this too much, but last year during the pandemic, the people who wanted to buy homes, a good part of them never lost their jobs. And instead they sat home and saved their money, and now they want to spend it. They can go to Disneyland, or they can buy a nice 3-bedroom 2-bath house with a picket fence in a nice neighborhood, a nice school district for their kids. They're going to veer toward buying that house. And so unfortunately for lenders out there, a lot of the activity out there is all cash, and because people have saved their cash. So you've got a lot of cash that people have saved up who would buy homes anyway. You have millions and millions of them more wanting to buy homes every year, and you have limited supply. So I'm bullish on housing, and I think I don't know if we'll see it going up 5 or 10%, but I still think it'll appreciate. On the other end of the spectrum, you asked, well, aren't units becoming available? Yeah, there is some inventory out there. It tends to get snatched up pretty quickly. And if individuals aren't buying them, a lot of companies, not a lot, but a handful of huge companies who own hundreds of thousands of single family homes will step in and buy those. And people always say, well, what about forbearance? What's going to happen there? Well, there's enough appreciation out there that the people who own the houses can sell. But if you look at the total numbers of people in forbearance, they still don't match the demand by the up and coming homeowners or wannabe homeowners. So I think the supply and demand equation is out of whack and almost out of whack no matter what you say. So I think prices will continue to go up.
I mean, that's the one thing that drives me to say prices will maintain, go up. There won't be a dip in housing prices because we just have a lack of supply. I think it was before the crash of 2000. I mean, I guess in my world, I really looked at it like 2006, 2007. That's when the secondary market really started to fall apart. 2008 is when all the banks really got hit with it and everyone knew what was going on. But up until that point, about 2006, I think we had about 1.2 million housing starts a year, right? And that was about the demand at the time. And then after the crash, I think we went down to like 400,000 or something. So we've dug a hole for a lot of years of just massive, not having enough inventory. So now I do see that prices will continue to hold steady, go up because there isn't supply. I mean, you just look around if you in people's neighborhoods and stuff. That just normally you see houses for sale signs. Now I don't see it. If I see one, it's down, and within a day there's a sold sign on it, and I'm hearing people saying, "Oh, there's 17 offers and one above asking," and it's just like, that's the difference is, I think to what you said about the forbearance is the last time we had this type of market where home prices went up and there's all this activity and there was this crash, home prices didn't hold. So when the forbearance, people lost their homes, everyone was underwater. Now people can sell their homes so quickly, right? So there's an out, so that won't affect the market. And to your point, there's more people looking to buy homes than are in forbearance. So that should take care of itself. What do you think? How do lenders, as they navigate this, changing landscape of customers and rates? Because who knows? There could be a day we have 10 or 15% interest rates again. That could be reality. I know the monetary policy changed somewhat at the Fed, and there's now this thought of that, but maybe inflation's not as bad as they thought it was, and maybe they're okay with some heavy inflation. So that could mean higher interest rates. But that doesn't mean people stop getting loans, right? Because people are still want to buy a house and still want to remodel that house or take cash out to put a pool in the backyard or send a kid to college or pay for a wedding or whatever it is. Like those things still take place. So what do you think lenders, position themselves now? How do they position themselves now for that future so that what do they do you think?
Well, I don't necessarily think that, we don't want the California MBA to say, Josh and Rob said rates are going to 10%. I don't see that happening anytime in the near future. But what I am seeing lenders do is have the product offerings that will take advantage of any kind of interest rate environment, especially an environment where not so much interest rates are going up, but there's continued house price appreciation. So to your point, what about home equity lines of credit? What about seconds? What kind of, for first-time home buyers, what kind of down payment assistance program do we offer? Because if rates do go up and affordability does become an issue, maybe more and more borrowers do need some kind of down payment assistance program. What kind of bond programs do we have in our company that we can offer? So it's not so much Fannie Mae, Freddie Mac, FHA, VA kind of thing, especially with Fannie Mae and Freddie Mac shrinking their footprint here somewhat with regard to second homes, non-owner occupied loans. But it's like, what kind of what kind of non-QM investors are out there? What kind of relationships do we have with those? What kind of relationships do our capital markets group have with investment banks? can we do our own securities? And so the execution on the back end, I think, is important. But on the front end, lenders are kind of keeping their knees bent, ready for what might get thrown their way in terms of interest rates. But they're trying to prepare for saying, okay, what about Hispanic or other minority borrowers? What do we have for that? What do we have for first-time home buyers? What do we have in terms of affordable housing programs that might appeal to that kind of borrower? So they're looking around. So they're not necessarily sitting on their hands saying, well, everything's going to be fine forever. Interest rates are going to stay where they are. They're looking around at other programs that they can add to their arsenal to help those groups of borrowers. And I think that's very, very important.
Yeah, I think that was good. Basically you're saying, towards the end there was lenders that start to figure out how to serve the underserved, because there are underserved communities and lending. So those lenders, and I know in California, and Rob, you're in California, I'm in Southern California. Hispanic community is is close to half of I think the California population, and yet there's not a lot of lenders that specialize in serving that community. And we see some that do that, and they just they do fantastic work. They grow rapidly. Their customers love them. So that serving those underserved, because again, we're talking about a service. You're in the industry of service, so if you can serve the underserved, that's what that is. And yes, I wasn't suggesting that rates are going to go to 10 or 15%. Thank you for clarifying that. That would be definitely a very scary thing if someone thought that they heard that. No, I'm saying it in the analogy as the market overall. That the point of it is, I always said there's a right financial product for every market. So it may be a second mortgage, it may be a HELOC, maybe it's a 125. I mean, I don't know if those come back into play ever again. People may, or the 105 or the 110 or FHA. Actually, people do FHA loans. It's actually the first FHA loan was actually like a 125 loan. It wasn't an actual home loan. It was the second mortgage 125. That was what it first got built for, if you will. So maybe those come back into play. So being on the offensive when it comes to looking for a product, staying informed, I think is important. Knowing what's around the corner. So as the market's changing, if you're a lender, if oh, this is a new product that may be coming into the market, I need to understand it better. How do I sell that? I think that's going to be, a big important thing. And then making the customers happy, wowing your customers. I think that's going to be the big thing. So last question for you. Kind of a big one, but what do you think the biggest challenge is this next 8 months, the rest of this year? What do you think lenders really need to focus on right now, or what do you think they're going to be facing?
It could be, unfortunately, right sizing. I think that if rates stay here or creep higher, the volume is going to be down. And the MBA, who and I respect the economics team quite a bit at the MBA, they predict the purchase business will pick up dramatically in 2021. But you're still dealing with an environment where so many borrowers have refinanced, and they may not be in the mood to refinance again, or may not make sense. So we are going to see a decline in volume. And it's easy to, as a manager, to go out, and hire people either in your footprint or hire, underwriters anywhere you can find them. When it comes time to cut back, and those cutbacks might be because just the market has slowed, or because technology has stepped in and helped, whatever it might be, scaling back personnel, especially because that's such a huge cost that lenders have. But scaling back personnel, I think, will be very, very difficult for a lot of managers and a lot of companies. It's no fun whatsoever. So I think that personally will be a big challenge for a lot of people. What are you hearing out there?
I think what you just said is probably right. It's not that the mortgage companies aren't excited about the future and making lots of money. They're just now looking at, okay, so last year we just threw as many bodies as we could at the problem. And really what's interesting is, lenders weren't really necessarily trying to do things differently to become more efficient last year. They're like, you know what? I don't want to slow down. Just throw bodies at it and let's do the same thing over and over again. Now lenders are, through even before the rates kind of crept up, we're starting to look at this year saying, hey, do I need this many people? Is this the right amount of people for my staff? What can I do? What tools can I use to be more efficient? How do I go from having 6 people look at a file to 5 people look at the file to 4 people? How do I get a processor from closing 25 loans a month to what are the tools I need to put in place so they can close 40 loans a month? How do I get my loan officer from handling closing 5 loans a month? How can I get them so they can handle and close 8 loans a month? Become more efficient. And then obviously the right sizing will probably be, like it is in this industry, a little bit of, it's going to be the bottom 10% usually. So maybe the people that weren't giving the greatest service to customers, didn't know the product, weren't doing the job as efficient as everyone else. So it can be helpful, I think, for the industry. But I do see that's a focus. If I was a lender, I would have been focusing on it last year, right? Yes, throw more bodies at the problem, but forget that's not the easier solution. Is how to become more efficient in what you're doing. Like, what can you do right now with your systems? I mean, shop yourself as a customer, right? Apply for a loan, see how the process is so you understand what it looks like. Then shop yourself as a loan, right? Make sure you understand every step the loan goes through, from the senior team, your CEO, understand what's going on. And you may find, wow, why do we do this way? Why do I have this person fill these boxes out and then I have to wait for this person to do that? And then, here's all these errors. You may find things that just are redundant, aren't needed, and become more efficient. That's really help. Obviously, our software helps with that, right? So our lenders use a lot of our software. What we have seen, I've seen a big increase in processors now coming on our platform over the last year. So not just loan officers that use our CRM, but the processors use the CRM, because if the processor interacts and talks to the customer, they need a system to help them manage that, and our platform's been doing that. So we have been seeing an increase in operational people coming into our software, and those lenders are now leveraging the technology just to make them more efficient, manage queues better, SLAs better, task management, and so forth. So I think that is a great place for lenders to start right now, is how to be more efficient. Look at it as just that. How do you become more efficient? And the people that are with you, they make more money. They're happier. They make more money because now they have more loans to work on and they're being more efficient. So that's a good one. Well, Rob, any other last thoughts before we turn it back over to the CMBA? Any jokes?
No, just keep that.
Where's the cat? No cat. I haven't seen Myrtle.
Myrtle's I think Myrtle's out, I don't know, catting around. No final thoughts other than just keep helping borrowers, and the rest will take care of itself.
Excellent. Hey, Rob, really appreciate your time. Dustin and everyone at the CMBA, thank you for letting us take over the podcast today, and you guys all have a great day.
Here we go.